Today I shall be covering a high-level view of what MiFID II is about and what actions you might take and what we're doing at IRESS. But I would say that there is going to be further webinar where we will dive down into more detail into what we're actually doing within the Products X-Plan Advisor Office. So before we get into the actual meat of the session, I just wanted to highlight what I'm sure is already self-evident, that we're a supplier of software, and whilst we do put a great deal of effort into understanding regulatory change and how it affects our clients, we are not a legal or compliance consultancy firm, and we would just stress that whilst we're happy to share our views, you will need to check the your own particular individual circumstances with your compliance officer or your compliance service provider before you take action. So in terms of the agenda, just to set the scene, I'm going to quickly run through what is MiFID II, why is it being introduced, and when will it come into effect? Who does it apply to? What are the core provisions? What are we at IRESS doing to help you comply? And some ideas about what actions you might take now. So what is MiFID II and what's it all about? Well, MiFID is a framework for EU legislation of investment intermediaries, really that get involved in selling and advising shares, units in collective investment schemes, and derivatives, collectively known as financial instruments. It also governs the framework for organized trading of those financial instruments. Now, as its name would imply, MiFID II is the second iteration of that legislation and framework, the first iteration being applied in the UK in 2007. It's now being revised and enhanced to take account of and address issues which came out of the financial crisis 2008, and also to strengthen investor protection. So if your business involves the distribution and trading of any financial instruments, then it is highly likely that you will be impacted. So just to drill down a little further on why it's being introduced, the key objectives that the EU and in this country the FCA are looking to achieve is increased investor protection, alignment of regulation across the EU. And I would just comment there that although we are going to be leaving the EU in a couple of years' time, there is absolutely no sign that the Treasury or the FCA are going to water down this legislation as it applies to the UK. There's every evidence that it will be applied exactly as it was intended when we were full members of the EU. It's also designed to help increase competition across financial markets, and it also introduces some reinforced supervisory powers. So for the purposes of this particular session, we're going to focus on the implications for financial advisors involved in selling or advising on financial instruments. So there will be some other aspects of the regulations which I'm not covering here today. We're really focusing in on the key impact on our X-Plan and Advisor Office clients. So who does it apply to? Well, deal with a fairly straightforward one. If you were impacted by MiFID I, then certainly all of MiFID II will apply to you as well. But there has been quite a bit of debate across the industry about what is known as Article 3 MiFID exempt firms. So under MiFID I, there was a category of advisors that were Article 3 exempt, i.e. exempt from a good number of the provisions of the regulation. But I would just caution that don't read that across into MiFID II, in that some of the regulations will be applicable. And secondly, the FCA has a responsibility to apply what is called analogous standards in a number of the areas of which we will go into. It's simply that the EU has decided that although some advisor firms may be exempt from the key rules, then they are saying that you would have to apply similar or analogous standards in certain areas. So again, I would caution you to talk to your compliance officer and make sure that you understand how the rules apply to your particular business. When does it come into effect? Well, it comes into effect on the 3rd of January 2018, so that's not far off now. And I think it is fair to say that this is a piece of regulation that has been quite a long time in the making, but an awful long time in the interpretation. So the EU actually passed the regulations a couple of years ago, and it has been then passed across to the 27 EU member states to decide how it will be deployed in each of their countries. And that has been quite a significant task. And I think we are still going through that process of defining exactly how those rules should be applied. So although the FCA has now issued 2 policy statements providing clarity around the rules, there is still quite a lot of debate within the industry as to how those rules are interpreted and applied. So I think we will see us going into a situation going into 2018 where the rules are technically in force, but the regulator, the FCA, has recognized that it will take a little while before the interpretation of those becomes clear. So what it's saying is that as advisor firms, as distributors of financial instruments, you must be taking reasonable steps to comply by the January deadline. Not everything, every T will be crossed and I dotted in terms of interpretation, but you certainly must have an understanding of what is required and a plan to comply and be taking reasonable steps to get there. So what are the main core provisions? First of all, look at the definition of independence. You may be aware that the Treasury kicked off a piece of work as part of the Pharma Review, looking at the definition of independent advice and seeing if it could create a greater degree of clarity between what is advice and what is guidance. It's also taken the opportunity to make sure that the definition of independence stacks up and adheres to the rules that MiFID will introduce. So the definition of independence has been reviewed and will be changed and narrowed slightly, such that to call yourself independent, instead of having to do a comprehensive review of the market, that will be replaced by a sufficiently diverse review of the market. Another area where there's some change is in that you could hold yourself out, your firm out, as being independent in a particular area of the market. So, for example, you could call yourself an independent pensions advisor. One thing to watch out for, though, is that an individual advisor cannot offer both independent and non-independent advice on MiFID products. It has to be you do one or the other. As a firm, you may offer both types of services, but individual advisors must not. In terms of permissions and the scope of MiFID products, that has been extended so that if you are advising on or arranging structured deposits, you will now need regulatory permissions. So you have to apply to the FCA to have that permissions extended through your Part 4A permissions. Now we come to one that is causing the industry a great deal of discussion and debate, and I don't think we have yet landed on any clarity around, and that's the disclosure of costs and charges relating to financial instruments. At one level, it is very, very straightforward what the regulations require. It simply says that you must provide either a new customer or an existing customer a view, an accurate calculation of all of the fees and charges that they will incur for that investment solution. So that includes the advice fees, any DFM fees, any product wrapper fees, fund management charges. It's just a simple statement to the client, either a new client. So if you're looking to invest 50,000, then these will be the charges that will apply over the first year. And similarly, if you have an existing client, then you must provide every year a statement of here are the charges that you've actually paid for the entire solution. Now, of course, whilst that sounds very straightforward, there are a lot of questions around the detail as to how do you actually calculate those costs and charges. Does it only apply to MiFID products? What happens if somebody's got something in their portfolio which is not a MiFID product? Do they need to be included or not? What happens if somebody's been investing and taking money out over the course of the reporting period? That too will need to be understood and calculated. The impact of assets held in different currencies, currency movements will also affect that. So it's a lot of work needs to be worked through to understand exactly how that will be created. But we would say that you're going to have to make that disclosure around costs and charges. So you need to understand and fix on an approach and make sure you start to capture the data from the beginning of January. Even if you have to report it by the end of the year, it might be useful to make sure that you have the data to actually produce that report. We move on now and talk about suitability. This is around advised clients. So here there's a couple of key things. Suitability has to be assessed and communicated not only when you're advising clients to buy financial instruments, but it also must be done when they're being sold, or even if you've done a review and you're saying to your client, you should hold that particular instrument. So suitability is assessed for buy, sell, and hold. There's also a requirement that the suitability letter must be produced before a transaction is concluded. I know at the moment there are some practices where advisors say, well, we'll produce that at the same time, or perhaps it comes out after the transaction has been concluded. That's not going to be allowed. The only dispensation is that there is a concession for sales carried out at a distance, i.e. telesales, where it might not be physically practical. But to all intents and purposes, you must produce the suitability letter before the transaction is completed. Appropriateness. So this applies to non-advised clients buying complex products. Again, just to give you some context here, what the regulations are trying to achieve is that they just want to stop naive clients who don't really understand the complexity and risks involved with the product that they're purchasing, from doing so without having some clear support. So, two questions to consider here. What is a complex product? Well, this is something the industry is really struggling to come to terms with, because what's complex to one person is not so complex to another. And I think the steer that we are being given by the regulator is to go on a case-by-case basis. So each advisor firm would need to come to a view and say, yeah, we believe this product here is complex, and hence we need to apply the appropriateness rules. And the appropriateness rules really say is that you must evaluate the understanding and experience of the client and check that the product which they have come in and asked to buy is actually suitable and appropriate for their particular needs. So it might be a question of asking, have you had this type of product before, and what sort of risks do you envisage that it would present? Interestingly, the regulations do not stipulate how the outcome of that test should be dealt with. So if somebody fails that test and you clearly believe that the person in front of you asking for a financial product says they clearly do not understand the level of risk involved, how do you progress from there? Do you make that sale with appropriate caveats and warnings, or do you stand back and say, I'm sorry, you'll need to go elsewhere to purchase that because we believe you don't understand and appreciate the risks involved? Come to another very interesting provision, which again is causing an immense amount of debate around the industry as to how do we calculate and implement this. And this is, again, very simple in concept. A 10% drop in the client's portfolio should be flagged up and communicated to the client. So if over the course of the last reporting period, your client's portfolio has dropped by 10% or more, then you need to, A, be aware of that. And if there is reason, good reason, then you should go and discuss that with your client and agree any appropriate actions. Again, there are all sorts of technical issues around how do you calculate that. So if the portfolio, again, is made up of assets broader than the MiFID products, do they need to be included? As I say, issues around the currency charges, again, they will have an impact on the client's portfolio. So there are a number of questions to be addressed and answered about exactly how do you calculate that. But I think the key thing to take away here is the spirit of the regulation that says if your client's portfolio, however you have defined that and however you manage that for the client, if that's dropped significantly in value, then of course it is appropriate that you're talking to your customers and discussing appropriate action. And I suppose from our point of view, we might say, well, why just 10%? You might want to vary that. Perhaps as a firm, you might think, I want to talk to my customers if it's dropping by 7, 8%. So I think it's a question of complying with the spirit of the regulation as much as the letter. Moving on then to periodic reporting to clients. At the moment, portfolio managers have to send a report every 6 months. That is going to move to at least quarterly. And of course, quite a lot of asset managers, fund managers, portfolio managers now provide their clients with online access to their portfolio and values there. And again, it's simply a question of demonstrating that if you follow that route and your online system provides that, then it does so in a sensible and reasonable way, and that clients can actually get to the appropriate information. Now we come to yet another very interesting provision, which has caused a great deal of debate around the industry, and that's the recording of calls, so actually taping telephone conversations. So the rules state that a MiFID firm, and that's if you're regulated in court as a MiFID II firm, then you will have to record client conversations, telephone conversations that relate to client transactions or which are intended to lead to a client transaction. Now, there has been quite a lot of debate as to whether there is an exemptions to that, whether you can just make manually recorded notes rather than incur the expense of putting in a call recording system. And our understanding is that Article 3 exempt firms will have the option to manually record and take notes of a call and attach that to the client file after the event. So if you're fully MiFID II, then you will have to tape. If you are Article 3 exempt, then you will have an option to manually record. Of course, some firms might decide, well, actually, rather than try and keep manual notes, I'll just go and actually install telephone taping. But I think all of that conversation, whilst it's been very interesting, has perhaps diverted attention from the broader requirement, and that is that actually MiFID II requires that records must be kept of all communications relating to the placement of trade. So that isn't just telephone calls. It is calls made on mobiles. So if your staff or advisors are actually talking to clients on mobiles, then you're going to have to find a way of recording those and attaching those to the client file. But it also covers emails, text messages, Skype calls, and of course, face-to-face conversations. It also extends to internal conversations. So again, even if you're just talking internally about a specific client transaction, then that conversation either has to be taped or notes made and put on trial. Come now to product governance, and this is all about placing a greater onus on the product manufacturers, so the investment houses, firms, etc., that are managing funds, and making sure that the products that they produce and design actually end up with the intended target market. So when a fund manager is putting together a proposition, they will have a target market in mind. And the impact here on the advisor firms and distributors is that they need to provide back to the manufacturers details of, in an aggregated form, of the products that they are selling. So what types of clients are buying the product, what sales are made outside of that target market, summary of the complaints received, responses to client questionnaires, client satisfaction type questionnaires, and also submitting back details, giving information on the processes and procedures that you as an advisor firm put in place to review their products and make sure that they are distributed to the right target audience. So here, to summarize, it's a question of providing more data back to those product manufacturers. And as you'd expect, this is another area where there's a lot of discussion around the industry as to how do we do that efficiently and effectively in a standardized way. We come then on to conflicts of interest. So like the RDR actually removed quite a lot of the conflicts of interest and put an onus on advisors to identify and disclose any conflicts of interest. This is extending it into the MiFID product arena. So for example, the free research that asset managers have produced and distributed out to advisors, the normal buy, sell, hold lists, that will be banned. So it will no longer be enabled to be provided free. And say there are also additional onus on identifying and avoiding conflicts of interest, and any remaining ones that can't be avoided, then they will have to be appropriately managed and disclosed to clients. And finally, we come to knowledge and competence. So we're familiar that T&C schemes should be in place for advisors. That has now been extended to client-facing staff that provide only factual information. So if a member of staff is talking to clients, but only to provide information, then we must put in place an appropriate T&C scheme to make sure that they are trained, updated, and only providing information in an approved way. So those are the main provisions. As I say, there are a couple of others around sort of best execution, making sure you get the best price for your client for the trade that you're executing. But I wanted to now move on to talk about what IRESS is doing in terms of its software products, specifically Xplan and Advisor Office. There will be a couple of those provisions where, frankly, our software, we cannot do anything to support you. They are decisions that you will need to make as an advisor business. For example, around independence. Do you wish to take advantage of, for example, becoming an independent pensions advisor? Similarly, around extension of your permissions to cover structured deposits, the conflicts of interest, and the knowledge and competence of staff not involved in giving advice. Those are areas that we'd say you need to address, but that's not the focus of our software changes. You can see, however, here that the other main areas, so things like disclosure of costs and charges, suitability, appropriateness, the 10% drop, reporting to clients, all of those areas, we will be and are developing our software to help you comply. As regards call recording, we will be creating the ability for you to manually record and then attach notes to the client file. However, as you'd appreciate, there is a large number of regulatory provisions, some of which are not yet completely clear in terms of how they will be interpreted and applied. So the way in which we will deploy that software is that it will be deployed over a number of releases and perhaps interim releases. So specifically, in terms of X-Plan, the 223 release was issued in July and 224 in September. They will contain MiFID II functionality. An Advisor Office 12.1 due out at the end of October, again, will include some MiFID II functionality. As the requirements are clarified, then we will produce further releases and interim updates depending on the nature of the particular requirements. So, what action could you take now? Obviously, there is a great deal to understand around MiFID II, and if you are involved with selling MiFID products, I'd strongly urge you to start reading the documentation. As you'd expect from the FCA, there is quite a lot of it. I'd suggest you read the policy statements 17.5 and 17.14. So you need to speak to your compliance officer, network services provider to, again, talk through your individual circumstances, compliance bulletins, and there's lots in the trade press, and also just talking to your colleagues and advisors in other firms to try and build a deeper understanding of the regulations and how they apply to your business. You might then want to start to review your client propositions. For example, do you want to continue distributing and advising on MiFID products? Can you take advantage of the change in definition of independence? If you're going to be selling structured products, then you should think about applying to the FCA ahead of the 3rd of January deadline. I'm sure there will be a last-minute rush around that, and you don't want to get caught up in an administrative approval backlog. You might also want to start reviewing your policies around call recording. Are you going to go down the road of saying, well, we might as well tape all client-related calls, or are you happy to take notes and record those against the client file? It'd be opportune to stand back and have another think around potential inducements and conflicts of interest and how you might handle the withdrawal of free research materials. As regards appropriateness, you might also want to think what happens if a client fails an appropriateness test. Are you happy to continue with the sale and document that accordingly? Or are you going to stand back and say, no, I'm sorry, you clearly don't understand that. I suggest you have to go elsewhere. Reviewing your operating procedures. Obviously, there's quite a lot of provisions there. For example, the 10% drop in client portfolio value. You need to think through how you intend to do that. And if so, when are you going to start collecting the appropriate data, making sure that you've got the appropriate data feeds to enable you to do that. Review when suitability letters are produced. As we say, there is a requirement now to do that before a transaction is completed. Moving down through, looking at the aggregated investment solution and costs and charges. Again, you're going to have to produce that statement, not only for new clients, but for existing clients. Again, you might need to think through about how do you start collecting the appropriate data, where you're going to source that data from to make sure you can give your client that holistic view of all of the fees and charges for their solution as a whole. You might need to think through and review your procedures for reviewing new products as they are launched by manufacturers, asset managers, and identify how do you identify the right target audience so you make sure you sell the right products for the right types of clients. And finally, you might need to think about how do you train staff that only provide information to clients. And finally, you might want to understand how technology can help, obviously, we'd encourage you to speak to your IRESS account manager. The Xplan 223 release is already available, and there is some further information about what we will be doing to the Xplan product. And also, as I mentioned at the start of this webinar, we will be running a further session, one for AO customers and one for Xplan customers, to focus on the detail of the product changes that we will be introducing via the next release. So that covered what I wanted to say on MiFID II today. I hope you found it useful. I would encourage you to submit any questions either online or talk to your account manager. As I say, we are working on our development of our products, and we will say more about that in due course. Thank you very much.